18 months ago, something shifted. Not the kind of shift that makes headlines. Not the kind where news anchors suddenly change their tone and start using the word recession like it's breaking news. This one didn't come with a warning banner across your screen. It showed up quietly instead. It showed up when people started leaning harder on credit cards just to maintain the same lifestyle. It showed up when small businesses began shutting down at a faster pace than usual. It showed up in interest rates that refused to settle back down, even after aggressive attempts to control them. If you're waiting for an official announcement to confirm that something is wrong, you're already behind the curve. Because what's happening right now doesn't behave like a typical economic cycle. This isn't just another dip followed by recovery. This feels different. And the reason it feels different is because it's not just about the economy slowing down. It's about the possibility that the system underneath the economy is starting to change. That's a much bigger deal. Hi, my name is Bryony, and I spend way much time thinking about why people who look financially reckless are sometimes better prepared for disaster than people who did everything right. If you've ever felt vaguely unsettled about how dependent your entire financial life is on one company, subscribe and hit. Most people have been taught to think about money in a very specific way. You earn it, you save it, you invest it, and over time it grows. That formula has worked for decades. It's simple, predictable, and for the most part, reliable. But that formula was built on a certain set of rules. And what happens if those rules start to shift? What happens if the foundation that made that system work begins to crack? Not suddenly, but gradually. That's the question almost nobody is asking. So instead of jumping straight into charts or predictions, I want you to picture something. Imagine the entire global financial system as a long-term agreement, not a contract you signed personally, but one that affects everything around you. An agreement that was made decades ago, after one of the most significant turning points in modern history. After World War II, the world needed stability. Countries needed a reliable way to trade with each other, to rebuild economies, and to create some level of predictability in a very uncertain environment. So a system was put in place. At the center of that system was one currency. The US dollar became the backbone of global trade. Countries held it in reserve. Major commodities were priced in it. It became the standard that everything else revolved around. In return, there was an expectation that the system would remain stable, that the currency would hold its value reasonably well, that the structure supporting it would be strong enough to maintain trust over time. For decades, that arrangement worked. It created growth. It created expansion. It allowed governments and businesses to operate within a framework that felt solid. But here's the thing about long-standing systems. They don't break overnight. They stretch first. They bend. They get pushed further than they were originally designed to handle. And eventually, people start to question whether the original agreement still makes sense. That's where things start to change. Not all at once, not dramatically, but slowly enough that most people don't notice until the effects are already happening. One of the biggest misunderstandings right now is where the real pressure is coming from. Most people look at debt levels and assume that's the core issue. They see large numbers and think that's unsustainable. But the size of the debt isn't the most important part. It's how that debt is structured. Decades ago, the environment looked very different. There was strong economic growth, a younger population, and a system that was expanding in ways that made it easier to manage large obligations over time. Today, the situation has changed. Growth is slower. Populations are aging. Costs are rising in areas that are difficult to control. And perhaps most importantly, the cost of maintaining that debt is increasing. That changes everything. Because once the cost of maintaining the system starts competing with the system itself, you reach a point where adjustments become unavoidable. And those adjustments don't happen in isolation. They ripple outward. They affect interest rates. They affect asset prices. They affect how money flows through the system. And most people don't see it happening because it doesn't feel dramatic in the moment. It just feels like things are getting a little tighter, a little more expensive, a little less predictable. At the same time, something else is happening beneath the surface. Trust. Not in the emotional sense, but in the structural sense. Trust in systems is what holds everything together. And unlike physical assets, trust doesn't fade gradually in a straight line. It holds steady for long periods of time, and then, when enough pressure builds, it starts to shift much faster than people expect. That's when behavior changes, not because people are panicking, but because they're adapting. When large institutions start adjusting where they place their money, they're not reacting emotionally, they're responding to incentives. If holding one type of asset becomes slightly less attractive, they begin looking for alternatives. Not loudly, not all at once, but consistently. And when enough of those small decisions start stacking up, the system begins to evolve. This is where things get interesting. Because while most people are focused on what's happening in their own country, the real shifts are happening globally. Trade relationships are changing, currencies are being used differently, agreements that were once standard are being reconsidered. None of this makes headlines in a way that grabs attention, but it matters. Because the system that people rely on for long-term financial planning was built during a very specific period in history, a period that may not look the same going forward. Now, think about how most people approach investing. They contribute regularly. They diversify. They trust that over time, markets will trend upward. And historically, that has been a very effective strategy. But that strategy assumes something important. It assumes that the underlying system remains stable enough for those patterns to continue. If the environment changes, the strategy doesn't necessarily stop working, but the outcomes can look very different. This is where a lot of people get caught off guard. Not because they made reckless decisions, but because they followed a system without questioning whether the conditions supporting that system were still intact. And to be clear, this isn't about fear. It's not about predicting collapse. It's about awareness. Because when you understand the environment you're operating in, you can adjust accordingly. You don't need to panic. You don't need to make extreme moves. But you do need to recognize when the rules of the game are shifting. Most people are still playing by assumptions that were formed decades ago. Low inflation, stable growth, predictable cycles. Those assumptions worked for a long time, but right now, multiple forces are starting to move at the same time, forces that don't usually align, and when they do, the outcome isn't always immediate. It's gradual, but it's significant. And if you're not paying attention, it's easy to mistake gradual change for normal conditions, until one day you realize the results aren't matching the expectations you had. That's when people start asking questions. But by then, a lot of the adjustment has already happened. So the real advantage isn't in predicting exactly what will happen next, it's in recognizing that something is already happening. And once you see that clearly, you start thinking differently about risk, about time, about what actually protects value over the long run. Because in the end, it's not about reacting to headlines, it's about understanding the structure underneath them. And right now, that structure is shifting. There's a moment in every major shift where the data stops being abstract and starts becoming personal. Not in a dramatic way, not in a way that forces immediate action, but in a way that slowly changes how outcomes begin to look over time. To understand that moment, it helps to look at patterns, not headlines, not opinions, but patterns that have repeated across different countries, different time periods, and completely different economic systems. Because while the details always change, the structure underneath them tends to follow a familiar path. Every dominant financial system in modern history has gone through a similar arc. It starts with strength, a period of stability, growth, and increasing influence. Confidence builds, participation increases, the system expands. Then comes overextension, not all at once and not necessarily as a mistake. Often it's the result of success. When a system works well, it gets used more. When it gets used more, it stretches further. And eventually it reaches a point where maintaining that expansion becomes more difficult. After that, something subtle begins: pressure. Not collapse, not failure, just pressure building in different parts of the system at the same time. And this is the stage that matters most, because this is where decisions, small, rational, individually insignificant decisions, start to add up in ways that reshape the system itself. Right now, there are several forces building simultaneously. Individually, none of them are enough to cause a major shift. Together, they become much harder to ignore. Start with what's happening internally. When wealth becomes concentrated at the top of a system, it doesn't just create social tension, it changes how money moves. A large portion of economic activity depends on broad participation. When most people have less spending power, demand becomes weaker in certain areas, even if overall wealth appears high on paper. That imbalance creates friction, and friction over time leads to instability. Not necessarily dramatic instability, but enough to make long-term planning more uncertain. When uncertainty increases, behavior changes. Investors become more cautious. Institutions start reevaluating long-term commitments. And one of the first places that shows up is in how people think about holding long-duration assets. If you're committing capital for 10, 20, or 30 years, you're making an assumption about stability over that entire period. When that assumption becomes less certain, even slightly, the math starts to shift. At the same time, there's pressure coming from outside. Global relationships are evolving. Trade is becoming more flexible in some areas and more fragmented in others. Countries are exploring ways to reduce reliance on any single system, not because they expect it to fail immediately, but because having alternatives creates leverage, and leverage changes behavior. If you have only one option, you accept the terms. If you have multiple options, you start negotiating. That shift doesn't happen overnight. It starts quietly. Small agreements, localized changes, experiments that don't seem significant at first. But over time, those small changes begin to form a pattern. And once that pattern becomes clear, it accelerates. There's a useful way to think about this. Imagine a group of people using the same platform for years because it's the only one available. Then a second platform appears. At first, almost nobody switches, not because the second option isn't good, but because the first one is familiar. But as more people test the alternative, even in small ways, the dynamic changes. Suddenly, staying becomes a choice rather than a default. And once that shift happens, the original platform no longer has the same level of control. That's the stage where influence begins to weaken, not disappear, but weaken. And that weakening shows up in subtle ways first. Pricing power changes, negotiation dynamics shift, long-term agreements become more flexible. None of this looks dramatic in isolation, but collectively, it alters the structure of the system. Now, bring this back to individual investors, because this is where things start to connect. Most people don't think in terms of global systems when they invest. They think in terms of portfolios, balances, growth over time. And for good reason. That's what directly affects their lives. But every portfolio is built on assumptions. Some are explicit, most are not.
For example, when someone invests heavily in domestic markets, they're implicitly assuming that those markets will continue to perform well relative to others. When they hold long-term bonds, they're assuming that interest rates won't move in ways that significantly reduce their value. When they rely on long-term projections, they're assuming that key variables like inflation and growth will stay within a certain range. None of these assumptions are unreasonable. In fact, they've been historically valid for long periods. But when multiple underlying forces start shifting at the same time, those assumptions become less stable. And when assumptions become less stable, outcomes become less predictable. This is where a lot of people run into a disconnect. On paper, everything still looks fine. Account balances may still be growing. Markets may still be performing. Nothing appears broken. But underneath that surface, the sensitivity to change increases. Small shifts in inflation have a bigger impact. Interest rate movements carry more weight. Currency fluctuations start to matter more than they used to. And over long time horizons, those small differences compound. Not in a way that's obvious year to year, but in a way that becomes very noticeable over decades. Now consider someone who has been doing everything right. Consistently investing, staying disciplined, avoiding emotional decisions. They're following a strategy that has worked historically, but their expected outcome depends heavily on a few key variables staying within a certain range. If those variables move even slightly outside that range for a sustained period, the final result can look very different. Not because they made mistakes, but because the environment changed. This is one of the hardest things to recognize because it doesn't feel like a problem in the moment. There's no clear signal that something has gone wrong. It just slowly alters the trajectory. And by the time the difference becomes obvious, it's often too late to fully adjust. That's why awareness matters more than prediction.
You don't need to know exactly how things will play out. You just need to understand which factors your outcome depends on, and whether those factors are becoming more or less stable over time. Right now, there's another layer being added to all of this: technology. Not in the abstract sense, but in a very practical sense. The way work is done is changing. The way value is created is changing. And that has a direct impact on the broader system. When productivity increases, it can reduce costs. That's a stabilizing force. But when that same technology reduces the need for certain types of labor, it can also reduce income in specific areas. That creates a different kind of pressure. Less income means less spending. Less spending affects growth, and lower growth feeds back into the system in ways that influence everything from policy decisions to market behavior. So now you have multiple forces interacting at the same time: internal pressure, external shifts, technological change, each one influencing the others, and none of them operating in isolation. This is why simple explanations don't work anymore. It's not just inflation, it's not just interest rates, it's the interaction between them. And when those interactions become more complex, the range of possible outcomes widens. That doesn't mean everything becomes unpredictable, it just means that relying on a single expected outcome becomes riskier. So instead of thinking in terms of one future, it becomes more useful to think in terms of scenarios. What happens if inflation runs slightly higher for longer? What happens if growth slows more than expected? What happens if global dynamics continue to shift gradually? You don't need exact answers, but asking the questions changes how you approach decisions, because instead of optimizing for one outcome, you start preparing for a range of them. And that's where resilience comes from. Not from being perfectly right, but from not being completely dependent on a single assumption. At this point, it's worth pausing for a second, because none of this is about reacting quickly. There's no urgency in the sense of immediate action. The changes we're talking about are slow-moving. They play out over years, sometimes decades. But slow-moving doesn't mean insignificant. In fact, slow-moving changes are often the most impactful because they're the easiest to ignore. They don't trigger alarms. They don't force decisions. They just quietly reshape the environment over time. And the people who tend to do the best in those environments aren't the ones who try to predict every move. They're the ones who recognize when the conditions are different from what they used to be and adjust accordingly. Not dramatically, not emotionally, just deliberately. Because when the structure changes, even slightly, the strategy that worked before might need to evolve with it.
At some point, all of this stops being theory. It stops being something you listen to in the background while doing something else, and it turns into a very direct question. What does this actually mean for your money? Because it's one thing to understand that systems evolve. It's another thing entirely to understand how that evolution changes outcomes that once felt predictable. So let's bring this down to a level that actually matters. Imagine someone in their early 40s. They've been consistent for years. They contribute to their retirement account every month. They've stayed invested through market ups and downs. They've followed the advice that's repeated everywhere. Be patient, stay diversified, think long-term. If you looked at their account today, it would probably look solid. Steady growth, no major mistakes, a clear trajectory toward a comfortable retirement. On the surface, everything is working exactly the way it's supposed to. But underneath that surface, there are a few key assumptions holding everything together, and those assumptions are rarely questioned. The first one is purchasing power. Most projections are built on the idea that money in the future will behave somewhat similarly to money today, not perfectly, but within a predictable range. If that assumption holds, long-term planning works beautifully. But if inflation runs even slightly higher than expected for a long period of time, the math changes in a way that's easy to underestimate. Because the number in the account still grows, it still looks bigger, but what it can actually buy grows much more slowly, or in some cases doesn't grow at all. This is one of the most deceptive dynamics in finance. Nominal growth feels like progress, but real progress is measured in purchasing power. And when those two start to diverge, it creates a gap between perception and reality. Now layer in the second assumption, interest rates. For years, low rates supported higher valuations across multiple asset classes. Stocks, real estate, long-term bonds,
all benefited from an environment where borrowing costs were minimal. That environment allowed future earnings to be valued more highly in the present. But when rates rise, that equation shifts. Future earnings are discounted more heavily, which means the present value of those earnings declines. This isn't a theory, it's built into the math that underlies how assets are priced, and it doesn't require a dramatic spike in rates to have an impact. Even moderate increases, sustained over time, can lead to a different valuation landscape. Now think about how most retirement portfolios are structured. As people get closer to retirement, their portfolios gradually shift toward more conservative assets, more bonds, less exposure to volatility. That approach makes sense in a stable rate environment, but in a rising or unstable rate environment, long-duration bonds can lose value, not temporarily, but structurally. And that creates a situation where the part of the portfolio that's supposed to provide stability becomes a source of risk. Again, not because the strategy is flawed in general, but because the environment it was designed for has changed. Now combine these two effects: higher inflation reducing purchasing power, higher rates affecting asset valuations. Individually, each one is manageable. Together, they start to compound. And that's where outcomes begin to drift away from expectations. Not suddenly, not in a way that triggers immediate concern, but gradually enough that it's easy to miss, until enough time has passed that the difference becomes significant. This is where discipline alone isn't always enough. Discipline keeps you consistent, but awareness keeps you aligned with reality. And when reality shifts, discipline without awareness can actually reinforce the wrong approach. That's a difficult idea to accept, because consistency is usually a strength, but consistency only works when the underlying conditions remain supportive. Now there's another layer to consider, and it's less obvious but just as important: currency exposure. Most people don't think about this at all. If your income, your investments, and your future expenses are all tied to the same currency, it feels natural. There's no reason to question it. But that also means you're fully exposed to whatever happens to that currency over time. If it remains strong and stable, that's fine. But if it weakens gradually relative to other assets or other currencies, your entire financial position is affected. Not dramatically in a single year, but steadily over longer periods. This is where global dynamics start to matter more than people expect. Because even small shifts in how currencies are used, traded, and held can influence their relative strength. And those shifts don't need to be extreme to have an impact. They just need to persist. Now, step back for a moment and look at the bigger picture. You have a system where multiple variables are becoming less predictable. Inflation, interest rates, global alignment, technological disruption, each one adding a layer of complexity. And most traditional strategies were built during a period when those variables were relatively stable. So the question becomes, how do you operate in an environment where stability isn't guaranteed in the same way? The answer isn't to abandon everything. It's not to make extreme changes or try to outguess the market at every turn. It's to reduce dependence on any single outcome. That's a subtle shift, but it changes everything. Because instead of optimizing for one scenario, you start building flexibility, and flexibility gives you room to adapt. For example, instead of assuming a specific inflation rate, you consider a range. Instead of relying entirely on one type of asset, you think about how different assets respond to different conditions. Instead of focusing only on growth, you also think about preservation of purchasing power. These aren't dramatic changes, they're adjustments in perspective. But over long time horizons, those adjustments matter. Now, there's one more concept that ties all of this together, and it's often overlooked because it's not as easy to quantify: incentives. Every participant in the system, governments, institutions, investors, acts based on incentives. And when incentives change, behavior follows. If maintaining stability becomes more difficult, policies shift. If holding certain assets becomes less attractive, capital moves. If alternatives become more viable, adoption increases. None of this requires coordination. It happens naturally, because each decision on its own is rational. But collectively, those decisions reshape the system. This is why transitions don't look like events, they look like trends, slow at first, then gradually more visible, and eventually obvious in hindsight. By the time something is obvious, most of the opportunity to adjust has already passed. That doesn't mean it's too late, but it does mean the cost of adjustment becomes higher. So the advantage comes from recognizing the shift early enough to make measured changes over time. Not reactive changes, not emotional decisions, just deliberate adjustments based on a clearer understanding of the environment. And that brings us to the most important part. Because understanding the problem is only useful if it leads to better decisions, not perfect decisions, better ones. And those decisions don't need to be complicated. They just need to reflect the reality of the system you're operating in. Because at the end of the day, the goal isn't to predict the future perfectly. It's to avoid being completely wrong about the present.
So now the question becomes simple. Not easy, but simple. What do you actually do with all of this? Because understanding a shift is one thing. Positioning yourself within it is something else entirely. And this is where most people either overreact or do nothing at all. They either try to completely reinvent their strategy overnight, or they convince themselves that none of this applies to them and continue exactly as they were. Both approaches miss the point. The goal isn't to swing from one extreme to another. It's to make adjustments that are proportional to the level of uncertainty you're facing. And right now, the uncertainty isn't about whether the system will continue. It's about how it will evolve. That distinction matters because it means you're not preparing for collapse, you're preparing for change. And change requires flexibility more than anything else. The first shift is mental. You stop thinking in terms of a single expected outcome. For years, most financial planning has been built around averages, average returns, average inflation, average growth. And those averages work well when the environment is stable. But when the environment becomes less predictable, averages become less reliable. So instead of asking what's most likely to happen, you start asking what are the plausible ranges of outcomes. That small shift in thinking changes how you evaluate everything else. Because now you're not trying to be exactly right, you're trying to avoid being significantly wrong. And those are two very different goals. The second shift is how you look at risk. Most people think of risk as volatility, prices going up and down, short-term fluctuations. But in reality, the bigger risk over long time horizons is loss of purchasing power. Not seeing it immediately, not feeling it day to day, but realizing years later that your money doesn't stretch as far as you expected it to. That kind of risk doesn't show up on a chart in a dramatic way. It shows up in lifestyle adjustments, in delayed plans, in smaller margins than you thought you would have. So protecting against that kind of risk requires a different mindset. It's less about avoiding fluctuations and more about maintaining real value over time. The third shift is diversification, but not in the way it's usually described. Diversification isn't just about holding different assets. It's about reducing reliance on a single environment. If your entire strategy depends on low inflation, stable rates, and strong domestic performance, then even a well-diversified portfolio on paper can still be highly concentrated in reality. True diversification means asking a different question. What happens to this portfolio if the environment changes in a way I'm not expecting? Not dramatically, just enough to matter over time. If the answer is it still works, then you're in a strong position.
If the answer is it struggles, then you've identified where adjustments might be needed. And those adjustments don't have to be drastic. They just have to be intentional. For example, having some exposure to assets that behave differently under different conditions. Assets that aren't tied to a single outcome. That could mean looking beyond just one market. Looking at assets that historically respond differently to inflation or currency shifts. Or even thinking beyond financial assets entirely. Because one of the most overlooked forms of resilience isn't in a portfolio, it's in your ability to generate value. Skills, adaptability, the ability to create income in different environments. Those things don't show up in a brokerage account, but they matter more than most people realize. Because no matter what happens at a macro level, value creation doesn't disappear, it just changes form. And the people who can adapt to those changes tend to do better than those who rely entirely on static strategies. Now, there's another important point here. None of this requires urgency. There's no need to rush into decisions. In fact, rushing is usually where mistakes happen. Because when you move too quickly, you're reacting instead of thinking. And reacting is often driven by emotion, not clarity. The changes we're talking about are gradual. They unfold over time, which means you have time to think, to evaluate, and to adjust at a pace that makes sense. That's an advantage, and it's one most people don't use, because it's easier to either ignore the situation or overreact to it. Taking a measured approach requires more effort, but it leads to better outcomes. Now, let's bring this back to where we started. Most people are operating within a system that was built decades ago, a system that worked extremely well under certain conditions. Those conditions may not disappear, but they may not look exactly the same going forward, and that's enough to matter. Because even small changes in the environment can lead to different results over long periods. So the real takeaway isn't that something is broken, it's that something is evolving. And when something evolves, the people who pay attention to that evolution have an advantage, not because they can predict everything, but because they're not caught off guard. They're not relying on assumptions that no longer hold. They're adjusting as the environment changes, gradually, deliberately, without panic, without overconfidence, just with a clearer understanding of the game they're playing. And that's really what this comes down to, understanding the game. Because once you understand the game, the decisions become simpler, not easier, but clearer. You know what you're optimizing for, you know what risks actually matter, and you know where you might need flexibility. Most people never reach that point. They follow strategies without questioning the conditions those strategies depend on. And for a long time, that works, until it doesn't. So the goal isn't to abandon what works, it's to recognize when the environment around it is shifting, and to adjust just enough to stay aligned with reality. Because in the end, the biggest risk isn't volatility, it isn't even uncertainty. It's being confidently positioned for a world that no longer exists. And right now, whether slowly or quietly, that world is changing. The people who recognize that early don't need to make dramatic moves, they just need to make thoughtful ones. And over time, those small, thoughtful adjustments are what make the difference, not overnight, but exactly when it matters most.